Welcome back. Just about 8 minutes left for the monetary policy. We are in discussion with Taimur Beg and also Neeraj Gambhir. Taimur, in terms of inflation, is there likely that there's going to be any revision of the target, considering that in the last quarter we were below the target and we have seen a big cool off in commodity prices, or are things too volatile right now? Taimur? Okay, I think we have lost that line. Let me ask the same question to you, Neeraj. Your thoughts?
So I think the volatility in crude oil prices is just too high. I think we are, just 2 months ago we were talking about an 80 break and maybe a trend towards 100, and whether we were wondering whether Reserve Bank needs to do a series of rate hikes to address the overall impact on macros. And in 2 months we are down back to 60. So I feel that it is not possible for the policy to swing so much as the market volatility is there, right? So policy will probably take a little bit of a time and see for the markets to settle down to a more predictable trend before they sort of start taking action. So I would like to see a sustained, say, 60 to 65 level of crude oil before, getting confident around the fact that we are now out of the woods in terms of our macroeconomic factors, and hence the policy can sit back and, change the stance back to, say, neutral.
Taimur, let's take that inflation question to you as well. And, Neeraj also raised an important point earlier, that while fair crude oil prices are down, core inflation has been showing a sticky trend, again getting towards that 6% mark. What sort of a pruning of the inflation expectations would you expect today?
Well, that was the issue that I had 2 months ago when I felt that was a time for RBI to raise rates. And I would still argue that given the information that was available at that time, particularly in the core inflation side, I think it would have been the right thing to do. Hindsight, of course, seems like, they were very smart and they did the right thing. I think within the forecasting horizon, once you take fuel away and don't have too many worries on the administered price side or the food price side, it's hard to come up with a very bearish view or hawkish view on inflation, if you will, that inflation has risk to surprise on the upside, particularly when you combine it with the fact that on the margin, growth momentum has been slowing since the April-June quarter. So I think that it will be very hard for me to imagine a major change in the inflation trajectory. And we all have our forecasting models, and nothing that has happened in the last couple of months to suggest that one would warrant a major change. As we all know, the role of energy prices in the core is, of course, minimal. And so I don't expect a major change in the inflation guidance provided by the RBI. But, I'm sure, I think we can all agree that the tone would be even less hawkish than it was in the last meeting.
Well, yes, tone is something that the market expects perhaps is going to be a bit dovish, and the market may well have priced that in. By the way, the bank Nifty is seeing a beautiful move on the upside right now. From the low point, that is, it's recovered a bit. Not by a whole lot, but still, going into policy with perhaps some bit of expectations. Neeraj, the other issue is, of course, perhaps it may not be the mandate of MPC. Perhaps it could be. Anything in terms of confidence steps for the market, either on the NBFC front or on the banking front?
So there is usually a developmental and regulatory statement that Reserve Bank releases along with the monetary policy. It's not a part of the MPC discussion framework, but usually that's timed together along with the MPC statement. And it's possible that in that we could see some regulatory steps to sort of strengthen the supervision framework for the non-bank finance companies. Though I think given where things are, my guess is that it's probably not going to be something very dramatic, and maybe it's just an incremental tightening of the supervisory framework. But I think it's entirely possible that we see something on that front.
Okay, let's bring in one more voice into this discussion. Sajid Chinoy, a chief India economist at JP Morgan, is also now with us. Sajid, good afternoon. About 4 minutes to go. Are you also expecting no change in rates? And also a word on growth. I mean, what do you expect the central bank to say as it takes note of this real poor 7.1% print we got for the second quarter?
I think we expect the central bank to be on a prolonged pause, just given how dramatically the global macroeconomic environment and domestic environment has changed. The three things I would look for is, we've seen this very sharp food disinflation again. And the question is, does the MPC think this is durable, or do they see food prices at some point bouncing back up? I think that's perhaps the biggest driver that will guide that inflation forecast. The second is to your point about growth. Was the second quarter just a hiccup? We don't think so. We think growth will sequentially soften further. So what the central bank thinks about growth. And the third is what they think about, the fast changing developments globally. Have growth inflation dynamics globally changed in their view? And are the event risks, the geopolitical risks, from the Iran sanctions to the China-US trade war, are they slightly less now compared to 2 months ago? So there's a lot that's changed, and my focus would be on trying to see how the MPC is handicapping these fast-moving developments both globally and domestically.
Okay, by the way, while our focus is on policy, don't lose sight of some of these stocks. Just pull out Jet Airways' intraday chart. That stock is collapsing now. Down about 3.5%, and all of a sudden there's a big decline on the stock. So 3.5% gone straight away right now as far as Jet Airways is concerned. ITC from the index is the other one which has dragged the markets quite a bit, and Larsen & Toubro as well, Surabhi. That's also making lows of the day. So there are a few stocks where we're seeing quite a bit of selling. But of course, REC's numbers, net profit at 1764 crore. Versus 1,400 crore. Of course, it's got bigger issues to worry about right now.
Exactly. I think the market wants to know if they are being made to buy PFC or if PFC is being made to buy them. So, and this is a stock that has enough issues surrounding it. Just about 1 minute to go, Sajid. We didn't get your take on the liquidity situation right now, and whether in addition to this 40,000 crores of OMO, you'd like the Reserve Bank to announce anything fresh.
I think you'll see a combination of instruments. I don't think the CRR will be used or should be used, given it's at 4%, and you ought to have enough ammunition left to slash the CRR in the event of, some catastrophic event globally. So I think a combination of, OMO calendar every month, along with the fact that now the BOP could well be in surplus, so at some point the central bank would be buying dollars to release liquidity, and then a combination of term repos. We've seen 28-day repos, 56-day repos. My sense is it's those three instruments that will be used to infuse liquidity for the rest of this fiscal year.
Fair enough. Just about 30 seconds left for the official monetary policy. So I don't think we have enough time now to ask any more questions. Let's just look at the bond market once again, and the currency market, and of course Nifty Bank. Right now the market's clearly in a wait and watch mode. Not wanting to take any kind of aggressive positions. That's the bond yield. I think it's been at this level for some time now. 754 is what you have. Even on the currency, so far we haven't had a big move. It's just pull out that. It's at 70.49, so almost where it was till about 10 minutes back. And also on the Nifty Bank as well, there's no big move which is happening right now. So I think we have officially hit 230.
We just have 10 seconds to go. Just a reminder, repo right now stands at 6.5. We'll find out if there's any change whatsoever. CRR right now stands at 4% and SLR at 19.5. That's where the key rates are. And no changes, I think, what we've got. Let's see if we can quickly cut across to Lata. From what I gather, immediately the flashes should come up for you. I think it's a status quo policy. Lata, if you can hear me, if you can confirm that for us, is it no change?
Yes. Yeah, it is status quo in stance and status quo in rates. Only Mr. Dholakia wanted a change in stance to neutral. So 5:1 calibrated tightening is retained. But I think what is dovish for the market is the steep cut in inflation estimates. Remember, the second half estimates were 3.9 to 4.5. Now they have been cut to 2.7 to 3.2. For the second half of the year, we are not going to see inflation above 3%, max 3.2. And for the first half of FY20, the average has been cut to 3.8 to 4.2. The old estimate was 4.8. So for the next 1 year, inflation is not going above 4%. As good as achieved the MPC's target. So I would think that this is a very dovish sign. Growth has not been changed. Now, what we need to note is that on growth, actually, they sound very sanguine. And they go on to say that the output gap is completely closed or practically closed. They even show quote numbers to say capacity utilization has increased and is running above the average. So, that way it is a very neutral policy. It says that inflation has come down substantially, will remain under 4% for the next 12 months. But it says growth is not terribly handicapped and output gap is closed, which means that given a chance, producers will be able to raise prices. To that extent, there is a small amount of hawkishness in the policy. Can you, reading this policy, be sure that there will be no rate hikes? Well, I think it is a long pause, but there is no indication of a rate cut just yet. That's the conclusion I can come to. But maybe you want to ask our experts. Sajid, what have you made of the policy?
Lata, really no surprises here. We've been discussing for a while now that the inflation trajectory is looking exceptionally benign, both on account of food prices and oil prices. So over the next year, these forecasts are virtually identical to what we have, which is why we think the RBI is going to be in a prolonged pause. We're a little bit less sanguine on the growth front. I think that sequentially growth momentum might slow. Having said that, the fact is the output gap is closed now. So even some modest slowdown in growth may not necessarily change pricing power in a dramatic manner. So really no surprises. I think the RBI is marking to market its inflation forecast and setting the stage for a prolonged pause.
1 minute, Sajid. 1 minute, Sajid. 1 minute. I also want to say that SLR has been cut. The SLR has been cut and will be cut by 25 basis points starting January 2019. A 0.25% every calendar quarter until you reach 18%. Now it is 19.5%. So for 6 quarters, SLR is going to be brought down. That is also an important addition. Neeraj Gambhir, what can that do to bond prices, you think? They have not given us HTM, but I mean, we don't know if HTM also is being brought down along with SLR. We have to clarify that. But considering that SLR has been cut, do you think that is another very dovish signal? How are the bond yields taken it? By the way, Anuj, how have the bond yields and markets taken it?
Lata, on the market, there's a bit of a positive reaction that you've seen, at least on the bank nifty. It's and a couple of financials. HDFC has been a strong stock that's moved a bit higher, so that's on the Nifty bank.
The yield 7.54.
The yield that we get is slightly delayed. Slightly delayed.
Yeah,
so I don't want to look at that right now. Currency market is perhaps something that we could look at, and on that I think there is a bit of a reaction that you're seeing right now.
The rupee has strengthened.
The rupee has strengthened.
70.38.
Yeah, exactly. The rupee has strengthened by Lata by about 4 paise, 4 or 5 paise, slightly more.
Absolutely. I mean, this is like really saying a conservative central bank saying that inflation is going to be under 4% for the next 12 months is a very strong statement. Okay, before I come to Neeraj, Taimur, how would you read this? 4% inflation, under 4% for the next 12 months, and yet output gap closed. In the next 12 months, are you seeing a cut, a hike, or a sustained pause?
So, as I said earlier, that with our nowcasting framework, we see growth slowing to below 7% by the Jan-March quarter. But again, when we say slowing, we're only talking about a 20-30 basis point slowdown from the current trajectory. That would not warrant any major reassessment of the output gap or the likelihood of economic trajectory having a bearing on the inflation forecast. So, from that perspective, I think the pause for the prolonged period may be warranted, but just like oil has crashed in the last couple of months, it can very easily resurge. And I think this is what the sort of insurance policy, if you will, that the RBI would like to hold on without sounding extra dovish, because just like, you can have oil at 80 and a month later it goes to 60, Iran sanctions could very well play a major role by the time we're in March. And we could again be looking wistfully at the $60 days.
Okay. Well, Neeraj, I want to come to you on the SLR cut impact and also some measures to improve liquidity management by banks. I will read it out to you because this is a bit jargon. Currently, the CRR balance of banks at the end of the day is being disclosed with a lag of 2 to 3 days, while the details of the currency in circulation are being released with a lag of 1 week. In order to enable banks to forecast the liquidity requirement with greater precision, it has been decided that the Reserve Bank will provide information on daily CRR balance of the banking system to market participants at the very next day. Accordingly, the daily market money market operations press release will combine the CRR figure for the previous day. Okay, nothing much. SLR cut, and how do you read this inflation forecast and output gap forecast?
So in short, the inflation forecast is dovish and positive for the bond market. the SLR cut is negative for the bond market because it's sort of takes away the demand that was there in the system to that extent. Now the market was hoping that in the last quarter, you will have Reserve Bank of India buying a fairly good chunk of government bonds, and that should sort of continue to be providing the sort of bid in the system, right? And with this SLR cut, I don't have the numbers as to how much is the impact on the demand, but that sort of balances out. So I think on the margin, it's kind of both these things kind of balance out for me, and I think the market should be pretty flattish. I don't think there is a very big cheer here for the market to go down substantially.
Lata, just to add, the bank nifty is slipping now, in fact quite a bit from the highest point. It slipped more than 100 points, the Nifty Bank. In fact, the Nifty is at the low point now, 104 points lower, and the Nifty Bank is also making a move towards that low point. And normally the case, your first reaction is reversed.
Anuj, I think the market could be reading that there is no very clear indication that the next move is a cut. To me, it looks like a longish pause. But Sajid, what do you think? Longish pause, or the way in which inflation has been cut, they are preparing the ground for neutrality and a cut?
Well, again, the RBI's objective is very clear. They want to keep inflation on a durable basis close to 4%. So I think to warrant a cut, we will need to see inflation forecast, at least for some period of time, meaningfully being below 4%, number one. Number two, I think what complicates this next year is the global environment. Yes, the Fed chairman was a bit dovish, but the fact is all the Fed is saying is they're going to be data dependent. And just given where output gaps in the US are, given where growth is over there, JP Morgan still believes there'll be 5 rate hikes in the next 5 quarters, 1 in this quarter and 4 in 2019. So that just makes it harder for emerging market central banks to consider cutting rates, even though their domestic growth inflation dynamics may warrant it, which is why I think is another reason, apart from what Taimur said, that there's so much volatility. Who knows a month from now where oil will be or where global growth will be. That's what makes it trickier.
Sajid, the governor will start speaking anytime. So just one more word, and I only want a monosyllabic answer. Neeraj, 1 full year sub 4% inflation. Is there neutrality or a cut in the next 12 months?
Neutrality potentially in a quarter's time, but I don't expect a cut. Because to me, core inflation is the big issue.
No cut.
Taimur? No cuts. All right. Anuj, all yours. I think the governor will be speaking shortly. Okay,
the governor will be speaking shortly, but before that, just look at the markets. Really all over the place. The PSU banks are making lows of the day, and it happens. You go into the policy, and a lot of people perhaps get into PSU banks ahead of the policy, thinking something positive could happen, and just that sheer weight of positions getting cut leads to this kind of move. So SBI is down. Canara Bank right now making lows of the day, so that's also looking quite interesting, and PNB as well. Now let's pull out the yield data, because the bond yield data, that is now I think we should get the first reaction rates. I think it's fairly stable. 754 is what you have. So Neeraj, you'll have to say that absolutely nothing. That's just no move in the market.
Like I said, you're balancing the positive of the dovish inflation forecast with the SLR cut. To me, that kind of sorts of balances out, which is why the market is where it is.
What about sort of the very benevolent outlook to growth that they've taken?
I don't think Reserve Bank has cut the growth forecast at all.
Which is what I'm saying. They still seem to talk about sort of capacity expansion levels moving higher, etc.
So I think growth is something which Reserve Bank typically tends to react a little later. They need to see a little bit more data before sort of concluding, because if the conclusion is that the output gap is closed, then clearly they don't believe that there is a lot of downside to the growth from here onwards.
Okay, well, we should have the governor speaking in the next couple of minutes. Just a word on some of the other stocks that have been on the move quite a bit. Jet Airways, you were talking about that one earlier. It's down 5% now. Sun Pharma is down over 5.5%. So some of the stock action is also fairly disconcerting on the way down.
No, I think on the market, this is interesting, because now on the Nifty Bank, what you have, the first reaction was positive, but immediately after that was sold into Surabhi. So and the mid-cap action is really interesting. 265 points down now on the mid-cap index. In fact, over there, things are unraveling rather fast. 1:3 is what you have on advanced decline. And my my sense is that this kind of move post the RBI policy is confirming the kind of reversal that we've been talking about. The Nifty now down about 88 points at 10,780. I think the one stock which is trying to bat for the bulls right now is HDFC. That's still in the green. And what's interesting is because of the strength in the rupee, even the IT space which was holding out, the IT index has moved into the red. And just pull out some of these names like TCS and Infosys, perhaps. That would be also interesting because that's also moving into the red.
A lot of the NBFCs, including marquee names like Bajaj Finance, stays low, M&M Financial, a lot of the NBFC names are also struggling, and they are down to the session lows as we're speaking. So largely speaking, the market's kind of not been very enthused. We're 92 points down on the Nifty and about 172 down on the Nifty Bank, again towards the lows of the day on both of those indices. We should be hearing from the governor over the next couple of minutes. Before we do that, maybe one quick question. Taimur, your sense on this SLR cut and whether this was perhaps the appropriate way to go? Your thoughts here?
It's a mild signal, some bit of a throwaway for the market to chew on when at a policy meeting when not much has been done, and maybe there are some technical aspects there. But generally speaking, I think banks who have ample liquidity will have ample liquidity, and banks who don't, I don't think this is going to change that much. And by the way, in the system as general, we know many banks who hold significantly higher than required threshold of SLR securities. So from that perspective, it doesn't really change the liquidity outlook.
Okay, I think you're getting live visuals now. I think the governor is getting ready to speak, and we should have him very soon. There's the governor. You want to make a point?
No, I was just waiting for him to speak. And Anuj, I was just getting back to the market overall. Yeah. This hasn't left the bulls overall feeling any better.
Policies are like that. Policies just have a 15-minute move, and then you move on. And you move on to other cues. The larger trend of the market downside is intact. I think Surabhi, the broader market that is 1:3 now on advanced decline. I think Kotak Mahindra Bank, Axis is making lows of the day right now. So even on the Nifty Bank, there's a bit of a selling pressure that you're seeing right now. So not looking good over there.
Okay, more stocks, Ujjivan, Escorts, Equitas, a lot of these names today. You've got plenty of mid-caps which have also been pretty weak. We should hear from the governor. I'm pretty sure it'll be interesting to note in detail what his take is on the inflation trajectory and why they've still not chosen to tweak the growth estimates this time around, sticking to 7.4%.
Thank you for coming to the press conference for the 5th bi-monthly of this fiscal year. The Monetary Policy Committee evaluated current and evolving macroeconomic conditions and voted today to maintain status quo, while reiterating its commitment to achieving the medium-term target for headline inflation at 4% on a durable basis. We noted that the global economy is likely slowing. The outlook is weighed down by decelerating global trade, ongoing trade tensions, and expectations of slowing demand. Crude oil prices have declined by close to 30% since they peaked in early October at about the time of the last policy, reflecting higher supplies and easing of geopolitical tensions. In many key EMEs, inflation has risen, but the recent retreat in energy prices and stabilizing of currencies may have a salutary impact going forward. Global financial markets have been volatile. With the easing of the US dollar, emerging market currencies in recent weeks have been trading with an appreciating bias. Domestically, GDP growth slowed in Q2 due to moderation in private consumption and net exports. However, the MPC noted that gross fixed capital formation expanded by double digits for the third consecutive quarter, and the growth of imports accelerated relative to imports, attesting to the underlying strength of domestic demand. Seasonally adjusted capacity utilization at 76.4% was above the long-term average of 74.9%. The latest round of the Reserve Bank's Industrial Outlook Survey reflects stable business sentiment in Q3, with sustained optimism about production and exports. This dovetails with the purchasing managers' indices for manufacturing and services that remained in expansion mode in November. In fact, the composite PMI output index touched a two-year high of 54.5 in November. On a year-on-year basis, non-food bank credit grew at 15.3% as on the reporting Friday of November 23rd, 2018. This is faster than the growth of nominal GDP. Moreover, the flow of bank credit has become increasingly broad-based, with even credit to industry emerging out of contraction from November 2017 and posting positive growth thereafter. Inclusive of banks' investments in commercial paper, shares, bonds, and debentures, the adjusted non-food bank credit increased by 15.6%. The total flow of resources to the commercial sector from banks and non-bank sources together has increased year on year by over 50% as on November 23rd. Turning to inflation, the MPC observed that retail CPI inflation dipped to an intra-year low of 3.3% in October, pulled down by food prices plunging into deflation, whereas inflation relating to fuels remained elevated, and excluding food and fuel, CPI inflation accelerated to 6.1%. While near-term household inflation expectations softened, they remained unchanged for the 12-month ahead horizon. In our assessment of external sector developments, the MPC noted that India's merchandise exports rebounded in October, but imports also grew at a faster pace, and consequently the trade deficit widened. On the financing side, net FDI flows moderated in relation to a year ago, while during the year up to November, there were net portfolio outflows. On the other hand, non-resident deposits increased markedly. Reflecting these developments, India's foreign exchange reserves were at about $394 billion as on November 30th. India and Japan have agreed to enter into a bilateral swap arrangement of $75 billion, which will provide a partial backstop to foreign exchange reserves and enhance the capability of the Reserve Bank to stabilize the foreign exchange market in situations of heightened market volatility and sudden stops and/or reversals of capital flows. On the outlook, the MPC was of the view that the broad-based weakening of food prices and the sharp decline in international crude oil prices imparts a downward bias to the headline inflation trajectory going forward. In contrast, there has been a broad-based increase in inflation in non-food groups. Accordingly, taking all this together, inflation is projected at 2.7 to 3.2% in the second half of 2018-19 and 3.8 to 4.2% in the first half of 2019-20, with risks tilted to the upside. Although recent food inflation prints have surprised on the downside and prices of petroleum products have softened considerably, it is important to monitor their evolution closely and allow heightened short-term uncertainties to be resolved by incoming data. As regards growth projections, the MPC observed that going forward, lower Rabi sowing may adversely affect agriculture and hence rural demand. Financial market volatility, slowing global demand, and rising trade tensions pose some downside risks to exports. On the other hand, the decline in crude oil prices is expected to boost corporate earnings and raise private consumption through higher disposable incomes. Increased capacity utilization in the manufacturing sector portends well for sustaining the acceleration in investment activity. As mentioned, bank credit growth has strengthened, and they should support productive sectors of the economy. Accordingly, GDP growth for 2018-19 has been retained at 7.4%, which means 7.2 to 7.3% in the second half, and for the first half of 2019-20 at 7.5%, with risks somewhat to the downside. A key point the MPC discussed was that uncertainty around the projections remains rather large, as while recent downward surprises have been large, they have also been over a very short period of time. First, few more months of data are needed to ascertain the full impact of minimum support prices on food inflation. And although prices of several food items are at unusually low levels, there is a risk of sudden reversal, especially of volatile perishable items. Secondly, and equally importantly, volatility indicators for crude oil prices and financial markets have not softened, suggesting that there remains considerable uncertainty in oil prices and international financial markets outlook, depending among other factors on OPEC supply decisions later this week and how the trade war, truce or otherwise, plays out. Finally, fiscal slippages, if any, at the center and or state levels will influence the inflation outlook, heighten market volatility, and crowd out private investment. On balance, the MPC is of the view that incoming data will help ascertain the durable nature of recent inflation softening and allow better judgment on future policy action. Hence, given the assessment that growth will likely remain healthy for the rest of the year, the MPC retained its stance at calibrated tightening so as to buy time to pause, reflect, and undertake future policy action with more robust inflation signals. If the upside risks we have flagged do not materialize or are mooted in their impact as reflected in incoming data, there is the possibility of space opening up for commensurate policy actions by the MPC. I will now request Dr. Acharya to say a few words.
Thank you, Governor. Good afternoon, everyone. I'm going to mainly talk on various aspects of liquidity management by the Reserve Bank. Since the last MPC meeting, the weighted average call rate at which money market participants transact in the unsecured funding market on an overnight basis continues to remain soft and below the policy rate on average. This has been possible due to deployment of a variety of liquidity tools. I'll mention the three primary ones. RBI has injected durable liquidity through open market operation purchases to the tune of now rupees 1.36 trillion in the current financial year. The pace of our OMOs has stepped up with the injection of slightly over rupees 1 trillion in the last 3 months. Second, the Reserve Bank has also provided liberal infusion of liquidity through term repos in addition to the usual provision via the LAF or the Liquidity Adjustment Facility. And third, as a supplementary measure, facility to avail liquidity for liquidity coverage ratio, or FOLCR as it's called. It was increased with effect from October 1st to enhance the ability of individual banks to avail of liquidity if required from the repo markets. Based on our assessment of durable liquidity needs going forward, we have already announced an OMO purchase program of rupees 400 billion or 40,000 crores for this month of December. We expect that this increased frequency and quantum of OMO purchases may be required until end of March, but the exact calibration will depend on sustained changes in the behavior of currency in circulation and the magnitude of sterilization operations for RBI's FX operations, which of course keep evolving with external sector conditions. Second, we also plan to conduct additional long-term repo operations to meet transient liquidity demand that is likely to emerge later this month on account of the third tranche of advanced tax outflows. Two things in the supplementary development policy, or Part B, that relate to liquidity. First is an operational change. It has been decided by the RBI that we will provide information on the daily CRR balance of the banking system to market participants on the very next day instead of 2 to 3 days at present, so as to help individual banks improve their liquidity assessment. Second, and a more important, market liberalization. It was proposed in the bi-monthly monetary policy statement in April of this year that non-residents shall be given access to the rupee interest rate derivatives markets in India. The draft directions in this regard will be issued after close of market today for public feedback. They propose allowing non-residents to hedge their rupee interest rate risk flexibly by using any available interest rate derivative instrument in the Indian markets. Non-residents who are already permitted to participate in interest rate futures market will going forward also be permitted to participate in the overnight indexed swap or the OIS market for non-hedging purposes, subject to a macroprudential limit on the collective exposure of all non-residents in terms of the interest rate risk that is being undertaken. We think this is a pretty important reform in the interest rate risk-sharing markets. Just excuse my indulgence, I'm going to now discuss in some detail the issue of funding liquidity for the NBFCs and the HFCs. The Reserve Bank has been watching the market developments on this front quite closely since end of August. We have been in regular touch with SEBI to assess the fallout in terms of mutual fund redemptions and the resulting rollover risk for NBFCs and HFCs. As I mentioned earlier, the Reserve Bank continues to provide system-wide liquidity at an augmented quantum and pace. In addition, and specifically for NBFCs and HFCs, we have increased the liquidity that banks can raise against their GSEC holdings as collateral, specifically also for on-lending to NBFCs and HFCs. And we've also relaxed the concentration limits on banks for lending to individual NBFCs and HFCs. The concentration limit has been increased from 10% to 15%. Importantly, the Reserve Bank has also taken measures to facilitate asset and risk transfers within the financial system. This can be considered as re-intermediation across financial players of risks. We believe this is healthy for financial stability overall. Just to give an example, when banking sector was getting recapitalized in the wake of corporate NPA recognition, NBFCs and HFCs picked up their market share. So to this end, to facilitate re-intermediation of this type, the Reserve Bank has taken two measures. First, it has allowed banks to provide partial credit enhancement on bonds issued by NBFCs, HFCs. This will help raise the credit quality of these bonds and thereby attract mutual funds to provide greater rollover funding to NBFCs and HFCs. And second, we have also relaxed the rules for securitization by NBFCs and HFCs, which should allow the risks to transfer to the better funded bank balance sheets. I want to stress that these measures have been carefully chosen from the full set of available options based on our analysis of the reasons behind the funding stress for NBFCs and HFCs. Our assessment is that these measures have collectively eased the funding stress in a steady manner over the past 2 months. And they have given NBFCs and HFCs time and the opportunity to make their own balance sheet adjustments on both asset and liability side, in particular improve the duration structure of their liabilities. Let me conclude. The Reserve Bank is guided by and large by the principle of addressing system-wide liquidity. The Reserve Bank also stands ready to be the lender of last resort, but that is provided conditions warrant that sort of an extreme measure. In our assessment, there is no such necessity at the present, given the sound health of our economy. And as Governor explained in detail, we are at a level of aggregate credit growth which remains comfortably in excess of nominal GDP growth with a fairly robust distribution across various sectors. Thank you.
Mr. Vishwanath. I want to highlight a few policies that have announced the Part B. We have been moving towards enhancing transparency in interest rates on loans. As a part of this, we moved from base rate to MCLR, which is more transparent than base rate. But in furtherance of this objective, now we are making it mandatory for banks that loans after 1st April 2019 for the personal retail segment and the MSE, micro and small enterprises, will be linked to an external benchmark. So we listed a few benchmarks and also allowed them to use any other benchmark that FBI will come with. And the actual interest rate will be spread over the base rate or the benchmark rate, which the banks can determine on their own. But that the spread is variable only if there is a change in the credit rating of the borrower as per the conditions of the loan agreement. So this will bring a lot more transparency in the interest rate, and the borrower will know the terms on which he is lending. Second, of course, is we had announced in April policy that we want to bring in a mandatory loan component in respect of the cash credit limits that large borrowers enjoy. So we are now coming out with final guidelines. We had issued draft guidelines. Response had come, and based on that, we are issuing final guidelines that take effect from April 1, 2019. That gives all the stakeholders enough time to plan and transition in a smooth manner. Of course, as I said, we will clarify as to how much percentage of the cash credit will have to be treated as loan component. That's coming out. The third is, of course, on aligning the liquidity LCR with SLR. So the liquidity coverage ratio is one of the important liquidity measures under the Basel III as part of the post-global crisis reforms. It requires that banks maintain high-quality liquid assets equal to stressed demand on the liabilities for 30 days. And this was phased in starting from 2015. At present, it is 90%. From January 19, it will become 100%. So what we are saying is that as a part of this move, we are also reducing the SLR, which is currently 19.5%, over a 6-quarter period to 18% at the rate of 25 basis points each. Currently, the banks are allowed to use a part of their SLR to be treated as HQLA for LCR. That will, of course, continue even after this. On the urban cooperative bank front, governance, given that the UCBs work under, cooperative banks work under dual control of the state government and the RBI, something that we have been working on. So right from the Malagam committee that was in 2010, there was a suggestion that the bank should have what is called as a board of management, which will work under the control of the Reserve Bank of India. And this was reiterated by the Gandhi High Power Committee under Mr. Gandhi on urban cooperative banks. So we had issued a draft guideline to the sector on this. Based on the recommendation that response we have received, we are going to issue final guidelines, making it mandatory for, which requires the banks to have a board of management. What we are saying is that the bank should actually have in their bylaws a provision for board of management, and the incentive is that unless they have a board of management, we will not allow them to expand their business, increase branches, etc., so that the banks which want to expand will have to put in place this arrangement. I want to also mention one thing that is not part of this policy, but something that we had announced earlier. In the October 2017 policy, we had announced that the bank should have special facilities for the senior citizen customers. And we had followed it with a detailed circular which required them to have special counters. There must be doorstep services provided to them, etc. We had also made it clear that non-compliance with these instructions will be treated as a case of deficiency in services, which can be taken up for redressal with the banking ombudsman. I just want to use this forum to reiterate that we take it's a very serious instruction that we put in place, and we would require the banks to implement these instructions in toto, and grievances, if any, that we receive from the senior citizens will be viewed seriously. Thank you.
Thank you, Mr. Vishwanathan. Mr. Kanungo?
Thank you, Governor. Just wish to highlight two paragraphs in the Part B. The first one refers to the foreign exchange transactions. As you would recall, the Foreign Exchange Management Act 1999, when it was enacted to govern the cross-border financial transaction flows, it started with 25 original regulations. But whenever we carried out an amendment or changed the rules, an amendment regulation had to be brought out, and over a period of time this had ballooned to more than 350 amendment regulations along with the 25 regulations. So we undertook an exercise to consolidate them. Actually, the objectives were fourfold. One is consolidating them into the primary regulations, 25 of them, then align it with the evolving business practices and the needs of the economy, then iron out the definitional differences that exist across various statutes, and also to soft code it so as to obviate the need of further amendments whenever you change the rules. You would have noticed that over a period of last 1 year or 2 years, we have amended consolidated 18 original regulations that archives 195 amendment regulations so far out of the 350. In continuation of that effort, we will be amending or rationalizing the borrowing regulations between the residents and non-residents, and bring out a new framework for the borrowing regulations, which will be announced by the end of the month. There are two measures rather in the Part B regarding consumer protection for the digital transaction. You would recall that in the recent times we have issued guidelines to protect the interest of the customers of the commercial banks, non-banking financial companies who are in the business of issuing cards, and the cooperative banks, so far as the consumer protection limiting the liability of the customers for unauthorized electronic transactions. However, such protection is not available when the electronic transaction is originated by a PPI issuer who are non-banks. So it has been decided that as a measure of providing the consumer protection to all the customers of all the segments, all the issuers, and bring them to the same level, we will issue the guidelines limiting the consumer's liability for unauthorized PPI transactions, PPIs are issued by non-banks. The framework could prescribe the limits up to which the customer may bear the liability against contributory frauds, negligence or deficiency on the part of the issuer, third-party breach where the deficiency lies with neither the issuer nor the customer, and the maximum loss due to negligence of the customer, etc. And we propose to issue the guidelines by the end of this month as well. Thank you.
Thank you, Mr. Kanungu. Mr. Jain.
Thank you, Governor. Very good afternoon to friends. I will give brief perspective on two policy announcements. One on Ombudsman scheme for digital transaction. The Reserve Bank's endeavor to build a less cash society has facilitated a significant rise in the volumes, value, and channels for conducting digital transactions. For promoting the level of trust and customer confidence in this powerful channel that has wide and deep reach, a dedicated and empowered grievance redressal mechanism is a prerequisite. Accordingly, an Ombudsman scheme for digital transaction is being formulated by the Reserve Bank to provide a cost-free and expeditious avenue for handling the rising number and growing complexity of such complaints. The Ombudsman scheme for digital transaction will be administered and funded by the Reserve Bank and will cover entities falling under the Reserve Bank's regulatory jurisdiction, it means beyond the banking as well, providing the related services. The next is setting up an expert committee on micro, small and medium enterprises. Micro, small and medium enterprises are one among the most important sectors forming the backbone of the Indian economy. Despite contributing significantly to the economy, large number of MSMEs units exist in informal space and face difficulty in accessing credit. Reserve Bank has recently taken several steps, such as setting up of trade receivables discounting system, that is called TRADS, operationalization of national mission for capacity building of bankers for financing MSME sector, allowing banks to co-originate loans with non-banking financial companies, etc., to facilitate flow of credit to the sector. In order to enable MSMEs tide over the impact of demonetization and GST, Reserve Bank also undertook regulatory forbearance in prudential norms. However, the increasing stress in the sector is a matter of concern. A comprehensive approach needs to be adopted to understand the problems of the MSME and the challenges faced by them for a holistic development of the sector. Keeping this in view, an expert committee would be constituted by the Reserve Bank of India to identify causes and propose long-term solution for the economic and financially sustainability of the MSME sector. The composition of the committee and its terms of reference will be finalized by the end of December 18 and report will be due by end June 19. Thank you.
Thank you very much, Mr. Jain. Take a few questions. Economic Times.
Thank you, Governor. You have given some hope of a reversal in the rate cycle if the upside risks do not materialize. So when the reversal happens, will it depend on your first half, second half forecast of inflation next fiscal, Or on the other hand, is it that how many months of undershooting of inflation target is required for you to change the course in interest rate cycle? Thank you.
Well, you know, as we have mentioned very clearly, including in the resolution and in my opening remarks, is that we need few more data points to ascertain the durability of the decline in inflation that has taken place in a very short period of time. Especially with respect to oil, the volatility now, the implied volatility now is actually higher than in October, although the price of oil has come down. So with incoming data, our projections will change and we will take a call as and when required. BTVI?
Good afternoon, Governor. A bit of a follow-up really on that question. It's been a sharp downward revision that we've seen for the inflation forecast. In fact, the midpoint of the second half projection is below the target of 4%. Why then has the stance been retained at calibrated tightening? And in that case, if this remains the stance, should we expect going ahead, as long as inflation is below that target, we will see a hold on rates?
I'll request Dr. Acharya to.
No, I think it's a good question, and in some sense the volatility of data make the decision somewhat difficult. But I think I would like to stress two things. One, we have to look for inflation staying at our target rate at medium-term horizon. So I think in some sense at Q2 of 2019-20, the number is 4.2%, which is basically implying that as of now, we are still slightly above the target at a 12-month horizon. So what has really happened is that the two surprises in food and oil in a very short period of time have, of course, brought the projections down quite significantly. Nevertheless, the medium-term target actually remains above the headline target. So I think we need to observe the data for a couple more months, first to see if these recent prints are durable or not. The recent prints have also created massive uncertainty, as Governor said. Actually, surprisingly, when oil prices rise, that is typically when the implied volatility in options markets for crude oil rises, but what we are observing is exactly the reverse. And it's not surprising because the collapse has been so dramatic in just less than 4-5 weeks. So I think what we are saying is that we really need some time in order to assess the inflation outlook better, and then we'll be able to take further policy action if necessary.
CNBC hours.
गवर्नर साहब, आपने अपने स्टेटमेंट में ये कहा कि नॉन फूड इन्फ्लेशन में आप एक अपवर्ड बायस देख रहे हैं, जबकि फूड इन्फ्लेशन घटने की उम्मीद है. नॉन फूड इन्फ्लेशन पे आपके क्या अजम्पशंस हैं, और ख़ास तौर पे क्रूड का क्या लेवल आप लेकर चल रहे हैं जब आपने ये अपने इन्फ्लेशन फोरकास्ट और ख़ास तौर पे नॉन फूड का फोरकास्ट बनाया?
एक्चुअली फोरकास्ट तो जो रेजोल्यूशन में है वो नॉन फूड नॉन फ्यूअल का है. सो it is not just a non-food projection, it's a non-food, non-fuel. The projection for that particular category of CPI inflation. And as is usually the case, and you can get a better idea on the assumptions, if you look at the MPR, which shows how we make adjustments with respect to inflation projections as the oil price and the exchange rate changes. So on oil, we generally look at the futures curve, which you also have access to, and on the exchange rate, we maintain an exchange rate which is basically the same as what is prevailing now.
तो क्या रेट है?
So, on what?
क्रूड का आपके इन्फ्लेशन फोरकास्ट में जो assumed rate है?
The futures curve, which actually changes every day, but we would fix it on the day that we are making the projection, which was yesterday.
Thank you, sir. I'm Somesh from Business Standard. Recently, analysts have talked about cut in the CRR as a way to provide liquidity in the system. So, was this discussed by the MPC? And if yes, why there was a decision to keep it unchanged? Secondly, about the recent developments, do you see the usage of Section 7 of the RBI Act as an attack on the autonomy of the RBI and the call for governance reform of the RBI? How do you see that?
I'll only answer the first question. With respect to the CRR, the CRR is not in the ambit of the MPC. And secondly, we see no reason to use the CRR when we have so many other instruments at our disposal, which Dr. Acharya and Mr. Vishwanathan enunciated, and which we have implemented over the last 2 months for liquidity management, which are broadly markets-based with some incentives. So the CRR is not countenanced at all.
So that's time now. It's time.
Thank you, sir, for the question. Just to follow up to the point you just made, have you, instead of doing OMOs, which also have a yield impact, even though you're balancing out your forex interventions at the same time, have you considered longer-term repos as a better option to do that because it will have much lesser impact on, the actual yields in the market? Because as soon as your comments have gone out, the markets have already started reacting.
The OMOs address durable liquidity, and longer-term repos, we have used 28-day, 56-day. They, at the end of the day, help to smoothen the relatively short-term and the more frequent liquidity shortages and surpluses. So that's for frictional liquidity. So the two instruments are quite different. I already said that I would avoid those questions because we are here discussing the Monetary Policy Committee resolution.
Sir, Dr. Viral Acharya ने कुछ बातें public domain में कही, क्या आप उससे सहमत हैं? और surplus funds के बारे में केंद्र सरकार को देने के बारे में कुछ फैसला है?
Sorry, repeat the last one.
Dr. Viral Acharya, इन्होंने कुछ बातें public domain में कही थी, इसके बारे में आप सहमत हैं क्या? और दूसरा, surplus fund केंद्र सरकार को देने के बारे में कुछ फैसला हुआ?
Is this related to the Monetary Policy Committee resolution? I don't think so. We are here to discuss the Monetary Policy Committee resolution and the macroeconomy.